Hey there, in today's video I want to look at the bucket strategy and how it can extend your retirement portfolio, and we'll do a quick refresher of what the bucket strategy is. Now before we get started, this is my standard disclaimer that you'd be absolutely crazy to listen to some rambling person on the internet or on YouTube giving you financial advice. This is not financial advice, it's entertainment only. So what is the bucket strategy? You've probably heard of the sequence of returns risk. And really what that says is, as you enter retirement, you've got far more risk of outliving your funds if you start off your retirement with a couple of negative years. And part of the problem there is because in a negative year, you have to sell some of your stock. And so you're selling your stock in a down year, and then you have to wait for it to recover. And as this chart actually shows from Nationwide Financial, getting back to break-even point is always more than the loss. If you have a 10% loss, you need to gain 11% just to get back to break-even. If you have a 20% loss, you have to get to 25%, and so on. You can see at a 40% loss to your portfolio, it has to gain 67% just to get back to break even. Never mind if you're actually selling stock for income in those down years, you have to get even higher return just to get back to break even. You can see how a couple of negative years can greatly influence your ability to retire successfully and not outlive your retirement funds. So just as a reminder of what the bucket strategy is. And there's different versions of the bucket strategy, but in essence, you've got one bucket that you put cash in, and you have another bucket that is your investment portfolio, i.e. your stocks and your bonds. And then you are generating your income from your assets. So once you go into retirement, you start drawing from either bucket. Some people use multiple buckets, a midterm, short-term, and a long-term bucket. But for purposes of this, I think two buckets is perfectly clear. So now let's just say that this is your stock market returns. In a good year, you actually take some of your stock portfolio, you sell some stock, and you generate income for your retirement. In a negative year, you'll leave that stock portfolio alone, and you'll take money out of your cash bucket as your income stream. And let's say you have another negative year, you'll take cash out of your cash bucket again. And then you might have a real gangbuster year, and then at the end of that year, you'll take money out of your investment portfolio by selling some stocks or bonds. So what you can see is that in these negative years, you're really drawing from cash, and you're not selling stock in this downturn, which means that you give it time to get back up again, and so that you're not losing money as you're selling stock into a downward trend. So that's effectively what the bucket strategy is. And I wanted to prove this out using Monte Carlo simulation. Now, just to get a sense of what Monte Carlo simulation is if you haven't really used it, the idea is we'll run 10,000 simulations of different returns. Now, these are not actual historical returns. We'll take the historical average with the standard deviation and then run 10,000 variations of that. So, if this is the zero line, a good run, might have generated random numbers like this, where most of it was positive. And you could go to an extreme situation where most of your returns was actually negative in the simulation. And so we'll run a total of 10,000 simulations to get a sense of how does a portfolio and algorithm work across 10,000 wildly different simulations. Because the problem with most retirement planning is they use on average the stock market returns 6% a year, and the problem is we don't live in averages. If you have 3 down years in a row, an average of 6% return a year doesn't help you any. So the nice thing about Monte Carlo is really looking at all extremes across 10,000 kind of simulations of that. So, if Monte Carlo says, you've got an 85% chance of success, you might be like, oh my gosh, that's a 15% chance of running out of money. And yes, it's true, but you got to look at the context here. That's based on taking the 15% of the worst case out of those 10,000 simulations. Worst cases that probably have never even happened in real life yet, where you get almost 30 years of negative returns. So you might be fine with 85%. Heck, you might be fine with 70% when you look at what this is actually telling you. But we'll also explore, what does it take if you want to go from 85% to 100%? What will that take if you really want that ultimate level of confidence. So let's go over to this Python code and run a couple of simulations here and see how the bucket strategy can help us. All right, so let's go over here to the Python script and let's look at the parameters. I'm saying I've got a portfolio value of 1.5 million as I enter retirement using the standard 4% withdrawal rate, but I'm saying that I have to draw at least 60,000 a year from this portfolio. Even if it drops below 1.5 million, where 4% wouldn't be 60,000, I'm saying I have a floor of $60,000 that I need. Now, in this entire example, I'm saying I need about 80,000 to live, and I'm assuming, say, 20,000 from Social Security. And we'll explore this a little bit more. And I want to make it last for 30 years. So let's look at these two, the front loading for 80,000. So what we're saying is, let me draw this out. If this is my timeline as my retirement income, I'm retiring at 59. I'm only going to withdraw Social Security at 67. And I know I need 80,000 a year. So for the first 8 years until Social Security kicks in, I have to withdraw 80K a year. Once Social Security kicks in, Social Security is going to contribute 20K. So I need the other 60K to come from my portfolio. So that's what this front loading is. For the first 8 years, I have to actually withdraw more. We're going to say the stock market returns on average 6%, but has as wild as a 15% deviation year over year. So some years could be well in the negative, some years could be well in the positive. Bonds 3% with a deviation of 5%. And we're going to run 10,000 simulations. Finally, I consider this a success only if I at least have $500,000 at the end of those 30 years left in my retirement portfolio. So maybe it's not quite die with zero. I either want to leave this to my heirs or, just have a level of comfort that should I live longer than 30 years, there's still some money left in the bank. So let's take a look what this gives us. So it runs through 10,000 simulations here and calculating my different options. And let's see what we've got. So pay attention here first. It's saying we've got a 66% success rate on that Monte Carlo simulation. Now remember what we discussed. That means that, the other 33% were those situations that were just so bad that where the bulk of them were negative and we just didn't make it. But 66% of the time, we succeeded, and in fact, we had a portfolio ending value of $802,000. If you look at, where did that graph go? So this is what the median, out of those 10,000 simulations, this is kind of what the median looked like here. Here's your zero line. And you can see retirement started off pretty well. We got almost 10%, 6%, 2%, a little bit of a negative year over there, but then a nice 15% return. Not a great return there, but for the most part, largely positive with a couple of negative years in between. That was the median out of those 10,000 simulations. And again, it looks like we have about a 66% chance when factoring in all 10,000 simulations, including, the 30% of the worst possible simulations that we have not seen in history. But 66%, do I feel comfortable with that? Not entirely. Now let's take a look at applying the bucket strategy. So if we have 120,000, which effectively 2 years of income in our cash reserve bucket, it's saying that we will have now a success rate of 87%. So it's taken us from 66% to 87% simply by having those 2 years of cash to withdraw from in the cash bucket. And if we looked at it on this graph, this was across all 10,000 simulations, but just by example of this median simulation, we can see there was the first year that we had negative. So we would take out the cash from that bucket. We then had a 15% return, then a negative 15% return. But remember, we took the money out of our cash bucket, the second year of our cash bucket, so we did not have to withdraw stock from our investment portfolio. And then we had a good run of positive years. So just by having those 2 years of cash to take out those two bumps of negative returns at the beginning of our retirement, we now ended up at 87.8% success rate, which on a Monte Carlo simulation, I would take 87% any day. But let's push this a little bit further. Let's look at the theoretical. How much cash would it take in the cash bucket to get to 100% certainty. So let the computer run through its little algorithm here and do another 10,000 simulations calculating different cash amounts. And let's see what we have here. So before we look at that, this is the result of the worst simulation. And if you look at here's the zero line, you had practically most years in the negative. You did have one gangbuster year up here, but most of these years were negative. And in fact, that portfolio had a 53% overall drop. So, just a absolutely awful return. But let's take a look at this. This is quite interesting. It's saying here that with 540,000 in your cash bucket, you've got the two buckets, 540,000 in the cash bucket, that you would have a 99.95% chance of succeeding in your retirement strategy. Not just succeeding, in fact, in the median return, you have 2.2 million left in your portfolio. And you can imagine why, because if we go back to this worst simulation of all time, 540,000 is at 60,000 is 9 years of income. So that's a negative. So it's 1, 2, 3, 4, 5, 6, 7, 8, 9. So it's almost the first 12 years of negative returns you've taken out, with allowing some growth of your portfolio in the meantime as well. So that's how you can get to your 100% certainty. Do you need 100% certainty? That's up to you, depending how well you want to sleep and knowing what a Monte Carlo simulation is actually telling you. But hopefully this will show you that you can find that happy balance between some cash, which takes you to an 87%, to a chunk of cash that takes you to 100%, and you can find that balance in between. Now, in the next video, I want to actually explore this further, because the problem with Monte Carlo simulations and 4% averages and all these kind of things that retirement planners keep talking about is it doesn't mimic human behavior. During your working career, if you lost your job at some point in your working career, I guarantee you that if times were a little lean, you would cancel your expensive vacations and you would cut back in certain areas and so forth. And honestly, when you're in retirement, you would do the same thing. So how does that kind of human behavior affect how much money you need in the cashback? What if you do hunker down in a lean year? Or in a good year, what if you take, the excess cash and replenish your cash bucket, etc.? So we'll explore a couple of those variations in the next video, and I'll see you then.